On March 17, 2027, the screens in Lower Manhattan didn't flash red because of a war. They flashed red because of a ledger. Traders stared at the same numbers, the same yield curves, the same cold arithmetic, and realized something older than politics had just shifted. We think empires fall because of presidents, generals, and speeches. But empires don't die on camera. They die in silence, when the balance sheet stops balancing, when the buyer disappears, and the word solvent becomes a memory. The story you've heard is simple. China sold all U.S. debt, and America panicked. But the truth is darker and more mechanical. This isn't about a country making a dramatic move on television. This is about the moment a creditor decides the debtor is no longer safe. This is about bankruptcy without the paperwork, insolvency without the announcement, and a system that keeps moving only because no one wants to be first to scream. The United States didn't wake up one day and lose a superpower rival. It woke up and discovered a line item was gone. One purchase order didn't clear, one auction didn't fill, one buyer wasn't there. In the modern world, that is how a crisis begins. Not with bombs, with absence. For decades, America wore majesty like a tailored suit. The dollar was the crown. Treasury bonds were the scepter. The Federal Reserve was the court wizard, promising stability with a few well-timed words. Every crisis ended with the same ritual. Investors ran toward U.S. debt like it was holy ground. The markets called it flight to safety. History called it trust. The ledger called it demand. Picture the peak. Container ships stacked like floating cities. American malls glowing at midnight. Cheap screens, cheap shoes, cheap furniture, cheap everything, arriving in endless waves. In Beijing, factories ran like furnace rooms, turning labor into exports, exports into dollars, dollars into treasury bonds. It was a loop so smooth, it felt natural. It was a machine that printed comfort for one side and growth for the other. And at the center of it all sat the strangest romance in financial history. America consumed. China produced. America paid in paper promises. China stored those promises like bricks. The U.S. called it borrowing. China called it reserves. The world called it globalization. The ledger called it a dependency. But beneath the surface, the foundation was rotting. Because the empire wasn't powered by virtue. It was powered by refinancing. The United States wasn't living off income. It was living off rollover. Every year, the government spent more than it collected. Every year, it issued more bonds to cover the gap. Every year, it needed buyers to show up like loyal patrons at a never-ending fundraiser. The deficit wasn't a problem as long as the auction cleared. The debt wasn't scary as long as the interest stayed low. That's the addiction. Not spending, not even borrowing. The true addiction was cheap borrowing. Debt is supposed to be heavy. It's supposed to force discipline. But cheap debt is like anesthetic. It lets you cut into the body without feeling pain. America could fund wars, rescue banks, expand programs, and hand out stimulus like candy, because the interest cost felt small. It was the same trick every empire tries. Keep the payments low, keep the crowd calm, keep the illusion alive. And the monster feeding on that illusion had a name, the bond market. People talk about the bond market like it's boring. They call it fixed income, like it's a sleepy corner of finance. That's how it survives, quietly, invisibly. But the bond market is the spine of the modern world. It prices your mortgage, it prices your car loan, it prices your credit card interest. It decides whether your retirement plan grows or bleeds, and it has no loyalty. In this story, the antagonist is not a politician. It's not a general. It's not even China, really. The antagonist is the cost of money, the creditor class, the auction, the yield. And for a long time, China played a role that made the whole system look stable. China was not just a trading partner. China was an audience member who kept buying tickets to America's show. The U.S. printed bonds. China bought them. The yield stayed low. The party continued. But addiction creates fragility, because when one supplier controls your calm, that supplier controls your panic. So the descent begins the way it always does, not with one big collapse, with a sequence of small humiliations that compound. First came the stress fractures in the 2020s. America's debt climbed into the tens of trillions. Interest payments swelled like a rising tide. The Federal Reserve raised rates to fight inflation, and the bond prices fell. That sounds abstract until you translate it into blood. When bond prices fall, somebody is holding losses. When rates rise, refinancing becomes a guillotine. The system can survive high debt or high rates. Together, they are a chokehold. Then came the geopolitical frost. Sanctions became normal, trade became weaponized, supply chains became battle lines, and every time Washington froze a foreign account or threatened a bank with exclusion, it sent a message to every capital on earth. Your reserves are not truly yours. They are permissioned, conditional, political. Let that sink in. A reserve asset that can be confiscated is not a reserve. It's a hostage. China watched that lesson in real time. It saw what happens when access is revoked. It saw how quickly rules become exceptions. And it started to treat U.S. debt like a liability instead of a trophy. But here's where the timeline turns into a spiral. Because China doesn't have to announce anything. It doesn't have to slam the door. It can simply stop showing up with fresh money. It can let maturities roll off. It can sell through intermediaries. It can trade quietly, like a thief who never breaks glass because the window is already open. And in our story, the number that people whisper is 850 billion. Not because we need it to be perfectly audited. Not because every last dollar is visible. But because the psychological effect is the point. The market doesn't move on truth alone. It moves on belief. The ledger is not just arithmetic, it's narrative. Now imagine a weekly Treasury auction. The U.S. sells new debt constantly. Bills, notes, bonds, a conveyor belt of paper promises. In the old world, the buyers were predictable. Foreign central banks, pension funds, big institutions, banks that needed collateral, and a Federal Reserve that could step in when the room got cold. In the new world, the room is cold from the start. When China sells, it's not just adding supply. It's removing confidence. It's telling the world, we've run the numbers. We don't like them. That message alone raises the yield. And once the yield rises, everything else starts to bleed. The rule is brutal and simple. Bond prices down, yields up, payments up, pain up. Think about the scale of that. A move in the 10-year yield doesn't just change a chart on CNBC. It changes the monthly payment on a house. It changes whether a business can refinance. It changes whether a bank's balance sheet survives. It changes whether a government can afford itself. So the spiral tightens. The first hit lands in housing, because housing is where the American middle class stores its identity. A 30-year mortgage is not just a loan. It's a monthly vote of confidence in the future. When rates rise, that vote collapses. Buyers vanish, sellers freeze, prices wobble, and then the wealth effect reverses like a tide going out. The gold was gone. The credit was frozen. The buyers had turned away. That's the rule of three. And when it hits everywhere. Corporations that borrowed cheap money years ago face a wall of refinancing. A debt maturity schedule becomes a death schedule. A company that could survive at 3% interest starts choking at 8%. Layoffs follow, defaults follow. Suppliers suffer. Cities collect less tax. Pension funds strain. The system becomes a chain of linked ankles, and the water is rising. And while that happens, the banks sit on the quietest bomb of all. Unrealized losses. Banks love government bonds because they're treated as safe. They're liquid. They're collateral. They're the bedrock. But when rates rise, old bonds lose value. That loss doesn't matter until you need cash. And in a panic, everyone needs cash at once. So now imagine depositors getting nervous, not because they understand duration risk, but because they feel fear in the air. Money moves faster now. A bank run doesn't require a line outside a branch. It requires a thumb and a screen. And when deposits leave, banks are forced to sell assets. When they sell, they realize losses. When they realize losses, capital shrinks. When capital shrinks, lending dies. When lending dies, the real economy suffocates. 3 words. Credit stops flowing. This is where the antagonist steps fully into view. The market. Not a human, not a flag, a force. The market doesn't care if you are America. It doesn't care if you are China. It doesn't care about speeches. It cares about risk and payment. And it expresses its verdict through yield. Now the story needs its smoking gun. The moment the fate was sealed, not by a missile launch, by a meeting. In our noir version of history, the room is not a war council. It's a conference room with fluorescent lighting and cold coffee. The table is polished. The mood is not angry. It's transactional. The people in suits don't shout. They slide papers across the table like undertakers. The document is simple. A reallocation directive. A reserve management memo. A set of instructions that changes the flow of money by changing the flow of trust. It's a foreclosure notice written in polite language. It doesn't say, "We are destroying you." It says, "We are diversifying reserves." It says, "We are reducing exposure." It says, "We are adjusting duration." Safe words, gentle words. But beneath them is the brutal sentence every debtor fears. We are no longer financing you. That is liquidation talk. That is the language of the pawn shop. The creditor doesn't need you to confess. It just needs you to pay more. And if you can't, it sells your paper and buys something it can touch. So the negotiation becomes a kind of financial interrogation. The Americans want stability. They want China to remain a predictable buyer. They want to preserve the illusion that the Treasury market is infinite and indestructible. They offer reassurances. They offer diplomacy. They offer access. But the ledger doesn't listen. China's side in this story answers with something colder than threat. It answers with math. It paraphrases the reality in a way that feels like a knife sliding between ribs. You borrow too much. You print too freely. You sanction too casually. You want us to fund the weapon aimed at us. No shouting. Just numbers. Just balance sheet logic. That's the smoking gun moment. The moment the relationship is redefined, not as partnership, but as counterparty risk. And once you become risk, you pay for it in yield. Then comes the climax, the default. Not the dramatic kind where the government announces bankruptcy and the flag comes down. This is a modern default, a soft default, a stealth default, the kind that happens when you pay, but the payment is worthless. Because when the system is trapped, the options narrow into 2 disasters. Option 1 is austerity. Cut spending, raise taxes, shrink the deficit. But austerity in an empire is politically suicidal. It means telling citizens the feast is over. It means admitting the majesty was rented. Option 2 is printing. Monetize the debt. Have the central bank buy what the world won't. Keep the auctions alive by becoming your own buyer. It works at first. It always does. It is the morphine shot. It calms the patient while the disease spreads. And that's where the phrase becomes prophecy. Sovereignty is solvency. If you cannot fund yourself honestly, you are not sovereign. You are a brand with a credit limit. When the printing accelerates, the social consequences arrive like winter. Prices rise, savings shrink, rent bites harder. Food becomes a negotiation. The middle class feels it first because the middle class lives on fixed payments and fragile plans. Hunger doesn't always look like famine. Sometimes it looks like skipping meat. Sometimes it looks like medicine you don't refill. Sometimes it looks like a second job that never ends. Coal doesn't always look like blizzards. Sometimes it looks like a heating bill you delay. Sometimes it looks like a car you can't repair. Sometimes it looks like humiliation. And humiliation is the real consequence of insolvency. Because insolvency is dependence. Dependence is loss of choice. The United States in this thriller doesn't lose territory. It loses control. It discovers that it cannot easily lower long-term rates without someone, somewhere, dumping more bonds and pushing them back up. The Federal Reserve still speaks. But the market speaks louder. That is the default moment. Not missed checks. Lost authority. Now we move into the aftermath, because history's cruelest trick is duration. The pain doesn't end when the crisis hits. It becomes a generation's climate. In this story, the years after the sell-all shock become a slow grind. Debt doesn't vanish. It gets rolled. It gets extended. It gets inflated away. It gets repaid with purchasing power stolen from the future. The final check is never written in one dramatic ceremony. It's written quietly, over decades, through the slow erosion of what the currency can buy. And that erosion leaves scars you don't need a microscope to see. You can measure it in everyday life. Household formation slows because people delay marriage, delay children, delay commitment. Birth rates fall not because people don't want families, but because stability has a price tag they can't afford. Mobility freezes. Workers stop moving for better opportunities because relocation now carries financial risk instead of upside. Entrepreneurship fades. People stop taking chances because risk requires confidence, and confidence requires a stable ledger. When money itself feels unstable, the future becomes something you hesitate to touch. You don't plan 10 years ahead when you're unsure about next year's interest rate. You don't start a business when debt feels like a trap instead of a tool. A society like that doesn't collapse overnight. It stiffens. It grows cautious. It becomes brittle. The children of the crisis grow up surrounded by the same phrases, repeated like folklore. Rates used to be low. Homes used to be affordable. College used to make sense. These aren't complaints. They're signals. They're reminders that the rules changed mid-game. This generation inherits a world where every promise comes with a hidden interest cost, where long-term commitments feel dangerous, where security is rented, not owned. That psychological shift matters more than any headline, because once a population internalizes instability, behavior changes permanently. Consumption slows, risk appetite collapses, faith in institutions erodes, not because of ideology, but because math stopped working in their favor. And on the other side of the ocean, China doesn't suddenly become a hero or a villain. It becomes something more realistic. It becomes a state that made a cold, calculated decision to reduce exposure. This wasn't about morality. It wasn't about alliances. It was about survival. Creditors do not rescue debtors out of kindness. They exit because they smell smoke. They read the numbers. They see trajectory, and they act before the fire reaches them. That's how large financial systems actually move, not with speeches, but with spreadsheets. Capital doesn't argue, it reallocates. Now zoom out. Because the real lesson here is not China sold. That's just the headline. The real lesson is that the ledger always wins. The modern world is built on trust in paper, bonds, dollars, contracts, promises stretched across decades. But paper only works as long as confidence holds. Resources don't require belief. Oil is real. Food is real. Copper is real. Land is real. Energy is real. You cannot print wheat. You cannot issue copper. You cannot quantitative ease electricity into existence. The future belongs to the side that can secure what cannot be created by keystrokes. When financial claims grow faster than physical reality, something has to give. History is not ultimately decided by armies or politicians. That's the myth. History is decided by accountants, by debt structures, by resource flows, by who can fund a system without begging external buyers, by who can feed a population without borrowing against tomorrow, by who can keep the lights on when the credit line snaps and refinancing disappears. Empires don't fall when they lose wars. They fall when they lose credibility with creditors. When rollover risk becomes existential, when the cost of servicing yesterday overwhelms the ability to build tomorrow. So when you see headlines framed as drama, ignore the noise and look for the quiet mechanism underneath. Ask who is buying. Ask who is selling. Ask who is rolling over the debt and at what interest rate. Ask what happens if the buyer disappears. Ask what happens if confidence breaks for even a quarter. Think about the scale of that. One major buyer stepping away doesn't just move a market, it can reprice the entire planet. Currencies shift, trade balances realign, living standards adjust, slowly at first, then all at once, all. If you want more documentaries like this, subscribe to the channel. Because the people who understand the ledger early don't panic with the crowd. They don't wait for official reassurance. They move before the doors close. They read the balance sheet while everyone else watches the parade. And by the time the music stops, they already know where the exits are.